There's been a lot of movement in the regulatory space. I want to provide a couple of updates on the UK's PSR proposal around providing enhanced protection for customers that fall victim to scams, but also the European Commission have outlined some initial principles of what PSD3 could look like. Dan Holmes here from Feed's Eye with the weekly update. There are some very clear parallels between these two respective sets of regulation. However, before we unpack those, I want to first start with PSD3. But before we get into PSD3, I firstly want to take a quick look back at PSD2 and in particular strong customer authentication, better known as SCA, which was a key component of that overall regulatory package. A retrospective review carried out by the European Commission has concluded that SCA has broadly had a positive impact in terms of reducing unauthorized fraud. However, one of the unintended consequences of SCA is that it's allowed other fraud typologies to emerge, such as scams, or better known in the European market as spoofing. Spoofing occurs when a victim is contacted by a scammer and the scammer convinces the victim to make an authorized transaction on their behalf. This presents a whole new set of challenges for banks in terms of protecting customers and better detecting those fraudulent transactions, and PSD3 attempts to address some of those challenges. It's laid out a number of key principles which I'll try and work through now. The first of these principles is IBAN name checking. For those familiar with the UK's confirmation of payee model, this proposal appears to be very similar. What it allows customers to do is validate that they're paying who they expect to pay through communication between the sending bank and the receiving bank. And in the event of a mismatch, a customer can be warned of that and potentially avoid a scam as it's occurring. The second principle is a legal basis and framework that allows banks to more effectively share data amongst one another. This is something that's becoming common in many parts of the world as banks recognise the scale of the scam and spoofing challenge. They recognise that fraudsters talk to each other and share best practices, and there's a realisation that banks need to follow those principles if they want to be able to stay ahead of the fraudster. So banks being able to share known bad data, such as known mule accounts or known high-risk beneficiaries, will ultimately allow them to make better risk decisions as transactions occur. The third principle is that banks will be asked to improve what they're doing from a fraud transaction monitoring perspective. Now, it's unclear in detail what that means at this stage, but one possible outcome could be that banks are forced to move away from a rules-based approach to fraud detection and focus more on an automated machine learning-led way of detection. The fourth principle is around education of both consumers and staff members. So it's recognised widely that customer education is a key pillar in any scam and spoofing prevention strategy. Banks are going to be forced to do more of that. What we're seeing is banks move away from traditional education and awareness where customers have to go hunting to find best practices and guidance, and we're starting to see banks overtly put that into user journeys as transactions are occurring. This education, presented at the right time with the right message, if done well, can allow the banks to make the customers their first line of fraud defence and potentially thwart the customer from actually making that transaction before it even hits the bank's fraud systems. Staff training is also a key part. Banks will need to ensure that their staff members are up to date with the latest scam trends and can remain credible and knowledgeable when a customer asks them for advice. The fifth and perhaps most important principle, however, is that customers will have enhanced rights to refund if they fall victim to a spoofing scam. Currently in the EU, there's no law that mandates that customers have to be reimbursed if they fall victim to a scam. PSD3 looks to offer some enhanced consumer protection in the event that certain scam types occur. That caveat of certain scam types is an important one because currently the proposal outlines that victims will only be reimbursed if they're the victim of an impersonation scam, so that leaves questions around investment scams, romance scams, and all these other types of scams that we know are at large on the market. The second caveat is that they may be entitled to a refund if there's a failure in the aforementioned IBAN name checking service. However, we will await further details to understand exactly what an error in that process means. This is important for banks because their risk exposure will be greatly increased. Currently today, they're not providing those refunds. They're going to have that liability going forward. That means they're going to have to find fraud budgets that they haven't previously had. We expect them to double down on their detection efforts and their technology efforts to try and offset some of that risk exposure that will be created by this new set of regulations. Moving back to the PSR, for those familiar with the concepts of PSR, there are some clear parallels to what I described in PSD3. The concept of the PSR is that it offers enhanced consumer protection if somebody falls victim to a scam. So in principle, that means more refunds more often. It also means a 50-50 liability split in a world first between the sending bank and the receiving bank, putting emphasis on both sides of the transaction to do more when it comes to consumer protection and fraud detection. Now, some details have emerged this week from the PSR that allow us to see, firstly, and most critically, an initial deadline date has been proposed, which will be April 2024. As we move towards that April deadline, finer details of the policy are starting to emerge, such as we now know that the initial proposal of £100 claim minimum limit has been removed, and that anybody who's a victim of a scam, regardless of the loss amount, is in scope for a refund. We also know that it will be faster payments only in the short term that are in scope for refund. This removes scams, therefore, that occur via a cash loss or via international transactions. The logic there is that data analysis shows that 97% of scams currently take place via the faster payment rails. Other payment types such as chaps will be considered in future iterations of the policy.